Looking forward to 2026, we remain cautiously optimistic. Now, why I say that is because we've actually seen rate cuts globally across every market, and even fiscal stimulus come up, which should actually start doing quite well in 2026, boosting economies overall. Now, of course, there's a question mark on the US, given some weak job numbers, but the consumer is still spending very, very strongly, boosting US GDP. So our view for global growth is above consensus, both in the US and other markets like Europe. But thinking about this fiscal impulse globally, you've now got Germany and even Europe spending money on defense. That should help boost economies. So for us, quite positive, but again, there might be some volatility along the way, especially in the first quarter of the year, as some of these more slow down numbers start to feed through in the market, but overall cautiously optimistic throughout 2026. Well, for right now, the main signal we're looking at is the US job numbers. Because for us, if the US goes into recession, or I should say US starts laying workers off, they're not going to be consuming so much, boosting global growth. So for us, if we do start to see some deterioration in those job numbers, that would be a concern to us and validate our more bullish stance. However, we still do remain optimistic. The market is muddied right now because we're not getting data because of the US shutdown. But if looking at, for example, initial claims, that's pretty steady. You're looking at war notices, that's an advance acknowledgement to the state that they're going to lay people off. That hasn't risen. So for us, it's more like a jobless recovery where new jobs are shrinking, but overall unemployment rate isn't rising. So we're going to watch that very, very closely because that could invalidate, or in another case, validate our assumption that growth is actually going to reaccelerate and the Fed is now cutting rates to defend the job market, even though they might not have to. So there's no country in the world right now that's trying to do fiscal consolidation. No one's trying to rein back in government spending. So if you think about US, Trump, Elon Musk, they tried for about 2 days, then they gave up. Even now with Trump's big, beautiful bill, more government spending coming through. The tariffs were supposed to help pay off the debt, but now Trump's saying potentially $2,000 checks to everyone. So again, there's no impetus for any government right now to rein in spending. Europe's spending more on fiscal stimulus in defense. We have even Japan now, the new prime minister coming out spending quite aggressively, even though their debt to GDP is extremely high. So what does that mean? Well, to have that much debt on balance sheet and to increase their debt, they're going to have to run economies hot to get rid of that debt. Default's not an option. Reining in spending is not politically palatable. So really, running economies hot means higher growth and higher inflation to inflate that debt away. That means more high-octane economies, more high-pressure economies, good for equities, less good for bonds, but ultimately winners and losers along the way, because the invisible hands of Adam Smith become a very visible hand of governments dictating where money is going to go. Clients keep asking, are we in an AI bubble? And there are arguments for and against. If you think about the arguments for a bubble, you have very, very stretched valuations. Valuations right now are not as bad as the dot-com peak or even the 2022 meme stock peak, but other than that, they're the highest they've ever been. So very, very expensive market valuations. Also very concentrated winners and losers. So think of the Magnificent Seven, the hyperscalers. They're dominating in earnings in everything. So very concentrated winners in that space. There's also circular financing. So the hyperscalers buy chips off NVIDIA, who then make them for TSMC, and that goes into Oracle. Anyway, there's a lot of financing going through, which is a concern. On the against a bubble side, these companies, at least the hyperscalers, are making lots of money. They're very profitable companies, and earnings keep beating expectations. I would have said they have strong balance sheets as well, because they're spending their cash on AI. What concerns me now is the leverage that's entering the system wasn't there before. But now with the Oracle deal or the Meta deal, debt is now coming in to the AI game. I believe that means we're at the start of a bubble phase. So you start to get worried when debt enters the game, but it's early stages. So we're watching that very, very closely to make sure no more debt comes into the system. Now, to cop out, we did ask AI, are we in a bubble? And all four said yes. So I'll leave it at that. So for us, we look at opportunities across the world. At a very high level, valuations are expensive everywhere. So the problem we have looking at that is US equities, very expensive. Australian equities also expensive. Even cheaper markets like Europe, Japan, and emerging markets are now above average, at best neutral valuations. So nowhere's really cheap from a top-down asset allocation perspective. When you look at bonds, same story. Lots of rate cuts priced, but we believe growth and inflation will be higher next year than the market. So again, sovereign bonds on average look quite expensive. Even credit spreads are very, very tight. So looking purely at valuations, it's not a very positive story for next year in terms of returns. However, where are there opportunities? Now, if you have the ability to be more dynamic and lean in and out of risk as you see opportunities rise, or having the ability to dive deeper and find pockets of opportunities, there are always opportunities out there. So for example, the US, again, expensive, but if our view is correct of stronger growth and inflation next year, that's above consensus. So you want to be buying the current dip in US equities, looking more forward for another year or two outlook. When it comes to Europe, there are pockets of opportunity even there. So think about Portugal, Italy, Greece, Spain. Those countries economically are doing very well right now, and they're still quite cheap. Cheap compared to Europe in general, cheap compared to their history. So we say the pigs are flying because right now we like Europe, but particularly the periphery in Europe. Emerging markets getting more expensive. However, rate cuts have come through in the US dollar is falling. So if you think about bonds in emerging markets, they can actually cut rates now because their inflation is falling. So positive on emerging markets in general, but also emerging market bonds. In the equity space, Brazil may be a bit spicy, but it is very cheap compared to history, and earnings are improving. So there are pockets of opportunity if you're willing to dive deeper and find those opportunities in a broad investment scheme.